So, ladies and gentlemen, basically, whenever we talk over a lease, what are we supposed to know about leases? What are we supposed to know about leases? That basically, when you lease an asset, the owner of the asset, the one we call the lessor gives you the right to use the asset for a given number of what year? A given number of years. For a given number of years. So in this case here, the moment you as the lessee, the moment in this case here, you have what we call the ROU, right of use. What are you supposed to know? What are you supposed to do? First of all, if it is the right of using this particular asset, I have to evaluate and really identify whether I have the right to use this asset. So how do I evaluate? First of all, I need to know the meaning of the word asset. What is an asset, ladies and gentlemen? Remember, an asset is any stuff that you have in the company, which in this case here, out of using it, you will be able to get what we call economic benefits. You'll be able to get economic benefit. And in this case, it can only be called an asset if you 100% control it. You are able to control this asset. So for example, like RCM Online College, we have leased some property at the Stanbank House. So in this case here, that small space that we have leased at Stanbank House, we have got every right to use it. Even the landlord himself, the moment we sign that lease contract, even the landlord does not have the right, in this case here, to come to my particular leased property anyhowly. It's my asset. If he comes anyhowly, I can easily take him to court for what here, somebody? I can easily take him to court for trespass. So for the 5 years and 3 months, the asset is as good as mine. I've got the right of use. Now, ladies and gentlemen, please listen. When I realize that, then I can control how this particular asset is being used. I can wake up, for example, one day and they say that the business of a college over there is not doing very well, and they change to a different business, for example, and put there a salon. So it means as the lessee, I've got the powers to, in this case here, make decisions over my space. Now I call it my space. So I can control what operations will happen in there. I can go there and say, today I'm painting it blue. So I've got the right of use. So if I've got the right of use, because basically of like what we call parent subsidiary, there is control, then straight away, I need to recognize this as an asset. I need to recognize it as an asset in my balance sheet. And of course, I will know. You know, when I lease an asset, I don't pay for it 100%. There will be these lease rentals. And those lease rentals are normally paid periodically, like monthly, quarterly, etc. So what I need to do is to discount those future payable lease rentals and get their present value, today's value. And that is what I will recognize as a lease liability. So 2 things. I must recognize an asset, what I shall be calling the right of use in the balance sheet. And then number 2, I will be recognizing what we call a leased a leased liability. But now remember, if in this case here, the lessor, this person you are calling the lessor, like now the landlord, has got powers of substitution. For example, if I go to Stanbank House today, and then I get this guy telling me that, you know what, today you're not going to use here, we are now taking you to the 7th floor. Then that is not a lease. If this guy can substitute, that's not a lease. But if he has restrictions, you know, there are people, for example, like at Stanbank, those guys will tell you in the lease that, for example, here, we don't allow any kind of business which is related to, for example, alcohol. So if it is restrictions and they still have got power, for example, from, you know, those are just covenants in the lease. So if it's restriction, then you can't say that I don't have really, those are just covenants. You're still in control. I can do anything regarding what here, for example, legal businesses. Now listen, I would want to be very clear here, and I would want to move pretty fast. So we are told here, we need to know, and this has been asked in your past paper, I'll be able to show you, identifying a lease. I need to know the lessee accounting, I need to know the lessor accounting, and I need to know the sale and the leaseback. You are giving me only 30 minutes to do this entire standard. It's a very easy standard. I normally teach it at my workplace. I normally do this practically at my workplace every day. Every day, I have this. So I'll be able to finish this. I'll be able to finish this in 30 minutes, and everybody will be very comfortable. Now, first of all, what is a lease? So we are being told here, IFRS 16 leases provides the following definition, that a lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. So it gives you the right to use an asset, and of course, you'll be paying what we call lease rentals. The lessor is the giver. The lessor is the owner of this asset, like the landlord, is the entity that provides the right of use of the asset. And in exchange, they receive, in this case here, what we call lease rentals. And then the lessee is the entity that obtains the use of the right of use asset, and in exchange, transfers what you call consideration. So right of use asset is the lessee's right to use an underlying asset over the lease term. How do we identify a lease? Ladies and gentlemen, I'm reading pretty fast, and I hope you're taking screenshots. You should be able to take screenshots as I read. You should be able to take screenshots as I read. You should be able to take screenshots as I read. And should you feel that I'm moving very fast, please also don't hesitate, really. You don't have any hesitations of telling me, Mwalimu, slow down. I'm just moving fast because I would want you guys to clear this paper. So then how do I identify a lease? IFRS 16 leases requires lessees to recognize an asset and a liability at the same time for all leases, unless they are short-term, like less than a year, or of a minimal value, If the leased asset is of a minimal value, then, ladies and gentlemen, you can't recognize that as an asset in your books. Minimal value. So two exceptions. You can be asked this in a theory. We can only, in this case here, not recognize a leased asset in our books, ladies and gentlemen, if it's number one, a short-term lease, or number two, minimal value. As such, it is vital to assess whether a contract contains a lease or whether it is simply a contract for a service. A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. The customer controls the asset's use if it has the right to substantially all of the identified asset's economic benefits. So in this case here, he has a right to all the identifiable assets' economic benefits. So any student who walks to RCM online, or rather RCM Standard Bank House, if they're going to pay fees there, that fees does not go to the landlord. It comes to me. So I'm getting, in this case here, all those economic benefits like that. And then number two, the right to direct the identified assets use. The right to direct the use of the asset can still exist if the lessor puts restrictions. If he puts restrictions on its use within a contract, such as by capping the maximum mileage of a vehicle or limiting which countries an asset can be used in. These restrictions define the scope of a leasee's right of use rather than preventing them from directing use. Ladies and gentlemen, I would want us to test our understanding. And if you get this, I should be able to give you a present right away. Test your understanding one. Coffee Bean enters into a contract with an airport operator to use some space in the airport to sell its goods from portable kiosks for a 3-year period. Coffee Bean owns the portable kiosks. The contract stipulates the amount of space and states that the space may be located at any one of the several departure areas within the airport. The airport operator can change the location of the space allocated to Coffee Bean at any time during the period of use. And the cost that the airport operator would incur to do this would be minimal. There are many areas in the airport that are suitable for portable kiosks required. Does the contract here contain a lease? Will you be able, ladies and gentlemen, to account for this contract as a lease asset under IFRS 16? Under IFRS 16, it's just simply a yes or a no. There are no two ways about this. What do you think after you read this contract there about Coffee Bean? So can Coffee Bean say that, hey, I have a lease. 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 Can he say that he has a lease really if you've been able to follow this? Can he say that he has a lease? No, you guys are right. There is no way, ladies and gentlemen, in this case, you can talk of there being a lease when the leased asset, you do not have control over it. You can see the owner of this particular departure points telling you that you, first of all, even by the name of portable, that you can move here from here. So in this case here, we have the concept of substitution. This guy can substitute. All right. So you are right. Thank you so much. Let's look at another one. The last one for purpose of demonstration. The last one for purpose of demonstration. We are told AFG enters into a contract with Splash, the supplier, to use a specified ship for a 5-year period. Splash has no substitution rights. Hawezi akakuchenjia meli. Hawezi akachange meli. Has got no substitution rights. During the contract period, AFG decides what cargo will be transported. So in this case here, AFG is the one, in this case here, AFG enters into a contract with Splash, the supplier. You remember Splash is the supplier. Splash is the lessor in this case. And the AFG, the one who has now leased this ship, decides what cargo will be transported. That shows control. When the ship will sail, kama ni saa 6 usiku, saa 1, really, and to which port it will sail. However, there are some restrictions specified in the contract. Those restrictions prevent AFG from carrying hazardous materials as cargo or from sailing the ship into waters where piracy is a risk. So there are some restrictions. Don't go here, don't go there. But at the end of the day, he is substantially giving you control. Splash operates and maintains the ship and is responsible for the safe passage of the cargo. So, ladies and gentlemen, will you account for this as a lease or simply a contract for services? Ladies and gentlemen, it doesn't matter what they tell me, so long as they give me. Remember, that's like in group consolidation. Control doesn't have to be like 100%. Anything above 50% is control. So even if he has some restrictions, he's telling me, hey, don't step here, don't. So long as this guy has given you powers that you can prove and say, hey, this thing, we are well controlling it. We are well controlling it. Then that is a lessor-leasee relationship. Now, ladies and gentlemen, if you allow me, I'll be able to share, in this case here, the answer. I'll be able to share the answer to this. Great. I promised you 30 minutes from the time I mentioned that chapter summary. Nope. I'm looking at leases, page number 157. Page number 157. This is way too hard. Really. Great. Once I set it up, it becomes very easy. Great. I'm almost there. Great. higher. So 157. I just come there and say 157. Okay, so ladies and gentlemen, then what we have here, we are starting very nice things. We are talking about leased assets are those assets that the lessee has got control over. If the lessee doesn't have the power to influence, the power to say, let my asset be used like this and like that, then automatically we shall have what here? An issue of lack of what here? Lack of control. So we start with example 1 here. Not leased asset, sorry. Great. Yes. So you can see, like, test your understanding to AFG. AFG has the right to use this identified asset, a specific ship, for a period of how many years? 5 years. Splash cannot substitute the specified ship for an alternative. AFG has the right to control the use of the ship throughout the 5-year period of use because it has the right to obtain ETC. I believe now this, you have been able, in this case, to at least get it at a high level. So therefore, based on the above, the contract contains what year? A lease. So if you allow me, I will be able to go to the mathematics now behind this. Mathematics behind this. And I would want us to look at this test your understanding 3. Test your understanding 3. On 1st of January, I can see chat, sorry, here. I can see chat, sorry. Thank you, yes. On 1st January 2021, Dynamic entered into a 2-year lease for a lorry. The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful life of how many years? 10 years. Lease payments are 10,000 per year for the initial term and 15,000 per year for the option period, the last year. All payments are due at the end of the year. To obtain the lease, Dynamic incurs initial direct costs of 3,000. The lessor will be able to reimburse 1,000 of these costs. The interest rate within the lease is not really determinable. Dynamic's incremental rate of borrowing is 5%. So they want me to calculate the initial recurring amount of the lease liability and the right of use asset and provide the double entries needed to record this amount in Dynamic's financial records. This is very, very easy. Ladies and gentlemen, I will start with lease liability. Lease liability. I will start with lease liability. This is what I will start with, the lease liability. So liability, I will look at what we call the lease rentals. I know I'm liable to pay the rentals here. And I will be paying these rentals over a period of how many years? 3 years. Over a period of 3 years. Over a period of 3 years. So, ladies and gentlemen, in this case here, what do we have here? They have told us here, lease payments are 10,000 per year for the initial term, per year, for the initial term, which was 2 years, remember. So 10,000 year 1, 10,000 year 2. 10,000 year 1, 10,000 year 2. And then we have, in this case here, the 3rd year, when I extend, I'll be able to pay some lease rental. I'll be able to pay some lease rental. I'll be able to pay some lease rental. And in this case here, in the 3rd year, I'm being told here, and 15,000 per year for the option period. Remember, we are told here, the contract contains an option to extend the lease term for a further 1 year. So then here we shall be able to pay 15,000. We shall be able to pay 15,000 there. So ladies and gentlemen, if that is the case, then we have 15,000 there. So remember, these lease rentals, of course, they are futuristic. What are we required to do? What we're required to do is to discount them. So in this case here, come and discount this by giving us PVIF. Use PVIF. You can decide to use PVF for the two, but I mean, these are very few years. I would rather separate this and assume that they are very independent. So I'm using present value interest factor. So have they given me the cost of capital? Remember, the cost of capital is the loan. You know, this guy is giving you a loan. A lease is a loan. The loan rate. Like in this question, they have given us yes, the loan rate. They have given us yes, the loan rate. They have told us, in this case here, the loan rate or borrowing rate is 5%. Is 5%. So if it is 5%, I know that this is at 5%. And I know the formula of PVF. Is there anybody who can remember the formula of PVF? Abracadabra. We normally talk of 1 plus R raised to who? 1 plus R raised to power N, negative. And then now you'll come here and they say 1.05 raised to negative 1 because this is end of year 1. Then we have 1.05 raised to negative 2. 1.05 raised to negative 3. I'm so sure you guys are not seeing where I got 1.05 from. Amoni. It's because of this formula. 1 plus 5%. 5% is 0.05. N is the number of year. 1 plus R. Thank you very much, Monica and Nene. Great. So are you able to get the first figure? So the first figure unasema 1.05 raised to negative 1. Negative 1, I'm getting 95. I'm getting a figure of 0.95. 24. Then I'll come and say replay there. I change this with a 2, and I'm getting here 0.9070. And then here I'll come and raise this to power 3, where I'm getting 0.8638 like that. Are these figures correct? Yes, I can see the marries. They are correct, yes. And then remember, what am I supposed to do? I'm supposed to come and click the last column and call it present value. The last column and call it present value. The last column and call it present value. So is there somebody who is able to give me these present values very first? Anybody who is able to give me these present values very fast way? They are not talking to me. I don't know who they would want to talk to. I don't know who they would want to talk to. I don't know who they would want to talk to. I don't know who they would want to talk to. So in this case, I'm reading your numbers very first because I don't want to use my calculator really. So the first one is 9524. 9524. Then we have 9070. How about the last one? 15,000 times this. 15,000 times this. 15,000 times this. 12,957. 12,957. So we have here 12,957. 12,957. 12,957. 12,957. So then could you kindly give me the total if you don't mind? Please give me the total if you don't mind. Please give me the total if you don't mind. Give me the total if you don't mind. 31,557. 31,557. 31,55 what year? 7. 31,557. 31,557. So automatically, this now becomes what we call the lease liability. So in this case here, the lessor knows that he is liable. It's like this particular landlord has given this guy this total loan today. Has given, in this case here, this guy, by giving you his asset like this, it's like he has given you his money, this today. So this is, in this case here, the total present value, which will be the same as the lease liability. 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 Now, after that, ladies and gentlemen, you also now need to recognize what year. Recognize the asset in the balance sheet. Recognize the asset because it is yours. Although we call it 31,557. 31,557. 31,557. Or is it 551? Oh, okay. Please, is it 31,551 like that? Is it 31,551? Please confirm. Thank you so much. So in this case, you recognize the asset. In this case here, what we call the right of use. Right of use. So the asset, remember basically, we are supposed to debit whenever you get this lease liability. Whenever you get the lease liability, what are you supposed to do? You're supposed to come under debit here, right of use, and then you credit what we call lease liability. Lease liability with the same amount. So here we have 31,551. Here we have 31,551. However, remember in the asset category, when you come in, like when we took RCM, Sternberg House, we had to paint. So the paint that you're putting there is your asset, especially if it's elongating. I mean, it's going to bring in more students. I mean students would want good billings. So in this case here, for the asset, there are expenses that you will have. Remember, use the cost model now. If you incurred any costs to make this asset better, you will come and make the adjustment. Like now they told us, yes, the direct cost, yes. They told us, direct cost, yes. They have told us, ladies and gentlemen, here. They have told us, ladies and gentlemen, here. What they have done, they have told us here. They have told us here. They have told us here. They have told us here that to obtain the lease, dynamic incurred initial direct cost of 3,000, and then the lessor immediately reimbursed this 1,000. So in short, the additional costs were how much? The additional costs were 2,000. The additional costs were 2,000. So in this case here, plus 2,000 here. So basically we are debiting, we are having an asset of how much? Remember, basically when you are recognizing an asset at first, initial measurement, basically you take what here the cost, how much cost do you incur? We have in this case here the loan to the landlord, plus in this case the cost of making good. So we have here 33,551. Remember this 2,000, I took the 3,000 I paid, but there was a reimbursement by the landlord over 1,000, by the landlord over 1,000, by the landlord over 1,000, by the landlord over 1,000. Okay, then from there, they also want us to give them what here? They also want us to provide with a double what here? Double entries. Double entries, this is a very, very easy thing. You can actually finish. Already we have started by doing it here, but you can finish by doing other journals here. There are other journals you can pass you as an accountant. I'm so sure you guys are very good with these journals. I'm so sure that you guys are very good with journals here. So there are other journals in this case here that you can come and do what here somebody, and then you pass to finish the entire thing. So if this is the case, then this is what we should do. I've not even seen that thing of I've not seen that thing of the journals. Allow me to do these journals then professionally. Allow me to do these journals professionally. Allow me to do the journals professionally here. Allow me to do these journals professionally. Allow me to do these journals professionally. Great. So then what we shall do, we have already gotten, in this case here, the lease liability. That's very important. So we have here debit, we have credit. So in this case here, debit, the right of use, because this is what here, our asset now. Then credit, in this case here, lease liability. Credit, lease liability. So the lease liability you guys got was 31,552. 31,552. And then, of course, the same amount should be booked here, 552. And then you come and ask yourself, in this case, ladies and gentlemen, what other expenses do you incur? So, for example, ladies and gentlemen, we have paid some 3,000 shillings. When we pay these 3,000 shillings, our bank account will be affected. So in this case here, I will come here and they say, although it's good to always start with debit. So we have here debit for this, we have credit like that. So you're saying we have made some payment. We have made some payment of 3,000 shillings. So this 3,000 shillings, so in this case here, this must have hit our bank. So we are crediting the bank with 3,000, but we are enhancing the value. We are enhancing the value of our asset. So again, you come and debit what here? Right of use with 3,000. And then remember, we had a refund. We had a refund from our landlord. Our landlord gave us back 1,000. So in this case, we should be able to receive that money. We should be able to go here and debit our bank, because now we are receiving our bank. And of course, because it was a reimbursement, out of this asset here. Remember, you had booked this amount here. So in this case, you come and credit what here? Right of use with that 1,000 like that. And then now you are home and dry, home and dry, home and dry. You are home and dry. So is that okay, ladies and gentlemen? You can't be perfect, fine, perfectly fine. But at the end of the day, we need to move on. We need to move on. We need to move on. Why they are not talking to me now? Now I'm an enemy. Now I'm an enemy. Great. Thank you very much. Now, ladies and gentlemen, please allow me to show you something very nice here. To show you something very nice here. This concept of subsequent measurement. Year one, we have been able, present value. We've been able to book our right of use asset. We have been able to book our lease liability. But now in the subsequent years, how do we do what we call subsequent measurement? Very, very important subsequent measurement. So in subsequent measurement, we are told the liability. The carrying amount of the lease liability is increased because you are given a loan. So you must pay interest. Interest is an expense. We shall debit, in this case here, finance cost, credit, lease liability. And then, of course, the asset itself will be reducing because of what here, somebody? The asset will be reducing because of depreciation. For us to understand this, look at this. Test your understanding for dynamic. This question follows on the previous test, your understanding required. Explain now the subsequent treatment of dynamic lease in the year ended 31st December 2021. I love this question because it is all over in your past papers. It is all over in your past papers. All over in your past papers. You'll be able now to see this concept of subsequent measurement. So wakisema sasa subsequent measurement, really, what does this mean? Wakisema subsequent measurement, the first thing you're supposed to do is to give us what we call a lease liability table. So right there for us, subsequent. Remember, this is initial recognition. Initial recognition. But subsequently, what shall we be doing? Subsequently. So mention there, subsequent measurement. And in the subsequent measurement, we start by giving our examiner the lease liability table. The lease liability table. Remember, we have got 2 years. Which years are these? We have 2021, we have 2022. So basically, you start with the opening liability. Opening. So in this case here, we have the opening amount. And of course, this liability is like I told you, this guy has given us a loan. We have to pay interest. So we have a column in this case here for interest or finance what year? Finance cost. Finance cost. So we know that the finance cost is 5%. And then now remember that this liability, we shall be repaying back. So in this case here, we have here payments. We have payments here. We have payments. And then lastly, we have what we call the closing. Closing. Please put your thumbs up once you are able to copy this table. Once you are able to copy the table, put your thumbs up. Once you are able to copy the table, put your thumbs up. Thank you. Great. So then, ladies and gentlemen, this is what we are doing here. This question of dynamic. And fortunately, we have been able to get the present value lease liability. Is there somebody who can give me this present value lease liability? The figure that we got. Present value lease liability. Is there somebody who can give me the figure? Present value lease liability nakuja ngapi? Apa. Present value. 31,551. Then, of course, this guy will start now charging us interest at 5%. Remember, a lease is like a loan. It's a mode of financing. So can somebody in this case here take 5%? So this will be 31,551 times 5%. Please give me this figure. Whole number only. Susan gives me 1570 something. Caroline, I'm looking for the third person will be able 1578. Now, let me ask you a question. Has this examiner told you how much you normally pay per year? If you look at your question, Have they told you how much you pay per year? Have they told you how much you pay per year? Have they told you how much you pay per year? Have they told you how much you pay per year? Have they told you how much you pay per year? Yes, they told us, like in year 1, they told us 10,000, and also in year 2, it will be 10,000, because remember, it is 10,000 per year for the initial term, and the first term was 2 years. So the payments, year 1, we are paying 10,000. This has to be in the brackets. Year 2, we are also paying 10,000. This has to be in the brackets. So then could you be kind enough by giving me the closing balance of 2021? You take this plus the finance cost increases this amount. And then you subtract 10,000. Whole number. So could you kindly give me 2021? 2021. Give me 2021. 2021. Always you assume it's in arrears, not unless it tells you it's paid in advance. You always assume it's in arrears. Okay, so I'm being given a figure of 23,129. 23,129. So if you're following, what figure should I take here? What figure should I take there? If you're following, what figure should I take there? The opening for 2022. It should be this figure that we closed with here. So then we have 23,129. So please come and give me the finance cost of this. So it will be 23,129 times 5%. Are you able to give me this figure times 5%? We get the finance cost. We get the the 11, 57, 56. I don't have a problem. Those are rounding off errors. I don't have a problem whatsoever. Those are rounding off errors. So I don't have a problem there whatsoever because those are rounding off errors. Okay, so then, ladies and gentlemen, what do we have here? These guys are not talking to me at all. So in this case here, come and give me, no, they have spoken to me honestly. They are telling me that Mwalimu, this is 1157. Somebody is saying 58, 1157. And then now the closing in this case here, the closing will be 287. This is a very, very important table. This is a very, very important table. Very, very important table. Out of this, I will be able to get my liability accounts there. I'll be able to get my liability accounts. Very nice. Very nice. Very nice. Very nice. Very nice. Very nice. So please let me know whether you've been able to finish this table. Then I show you something very nice. Let me know whether you've been able to finish the table. Let me know whether we have finished doing this table. Woi, niko peke yangu. Oh, no. Wengi wameshamaliza. Thank you very much. Now, ladies and gentlemen, please listen and listen to me very well. So in this case here, in my lease liability, so I'll come and mention here, journal entries into lease liability, Now, I'm so sure that you guys remember this acronym that I taught. I must have taught most of you in CPA 1. The students that I taught in CPA 1, they must be remembering this acronym. We call it PALS. That purchases, expenses, and assets have a debit entry. Purchases, expenses, and assets have a debit entry. Whenever they increase, you debit. These others, whenever they increase, you credit. Remember, this is a revenue, liability, share capital. So PALS, purchases, expenses, assets. I hope you have written this in full. Purchases, expenses, assets. Then we have in this case here, revenue, sales revenue, of course, liabilities and share capital. Then whenever they increase, you do what here? You credit. So I don't know whether you've been able to write this in full. This is very, very important. Have you written this in full, PALS? Have you done that? Thank you very much. Now here there are two columns that will affect us. Here there are two columns which will affect us. Two columns. In the liability, journal entry is going to the liability. We have this column. This column will affect us. So what is finance cost? Finance cost is an expense to a company. Let's see, finance cost is paying the interest. Finance cost is an expense. Expenses we debit. So you come and tell us here, debit finance cost. Debit finance cost. And then we have in this case here, credit lease liability. Because liability you credit with them, never they increase. Remember, it's only for 1 year, for the first year. So in this case here, we have 1578, 1578, like that. That is the first one. We also have this other column here, this column here. This column is reducing my liability. The column there is reducing my liability, and of course, my cash is going down. So in this case here, I know what to debit, and then I know what to credit. So we have said that we are crediting cash with this column because it's a payment, cash or bank. So credit cash, stroke what here, bank. And then, of course, I debit because these are journal entries going to lease liability. The contra, the other account is the lease liability. So then we have lease liability, lease liability, lease liability, lease liability, lease liability, lease liability with 10,000, 10,000, 10,000. Of course, those narrations, you can write anything down. They can even write a dog is a dog. Nobody looks at those narrations, but they are very important for you to put them there. So like now, this one here is being the finance cost charge. This is being the lease rent or paid. You could always be adding something there. Something there. So, but you see, you can't do this without doing this lease liability table. Without doing the lease liability table. Right? And in most cases, they normally tell you to do for the first year. You don't have to look at even what is in the other years. Not unless they are telling you to differentiate between non-current and what year? Current. But we shall reach there. We shall reach there. We shall reach there. Now, ladies and gentlemen, after that, please let's write there journal entries into right of use. Mention there journal entry, because as a leasee, you're looking at your liability status and your right of use status, which is the asset. So mention there journal entries, now going to who? Going to who? To the right of use or the asset. Or the asset here. So we have here journal entries, dash, right of what here? Right of use. The asset basically. So then what are we looking at here, ladies and gentlemen? What are we looking at here, ladies and gentlemen? What we are looking at here is a very simple thing. Remember right of use, ladies and gentlemen? Right of use, ladies and gentlemen, we shall always compute depreciation. We shall always compute depreciation. That is the only journal entry here. So is there anybody who is able to compute the depreciation? Is there anybody who is able to compute the depreciation really here? Depreciation of this asset, leased asset. Depreciation of the leased asset. Is there anybody who is able to compute this depreciation of the leased asset? That is the only thing you do. So in this case here, they are telling us that into a 2-year lease for a lorry, the contract contains an option to extend the lease term for a further, so it's 3 years. Lorries have a useful life of 10 years. So the first thing that I know is that in terms of depreciation period, I have the economic life of the asset. Economic life of the asset. They are telling us, ladies and gentlemen, this is 10 years. And then we have the lease life. The lease life. The lease life is 3 years. We always compare the two for purpose of depreciation, and we always take the lower. The depreciation duration. We always take the lower. We always take the lower. We always take the lower. Depreciation, we always take the lower, isn't it? So in this case here, we take how many years here? Somebody? 11. Already, I can see somebody already has the depreciation amount. Somebody already has the depreciation amount. Before I help Lydia. Somebody already has the depreciation amount. Now, ladies and gentlemen, I would want a good student in this case here to give me the depreciation. Somebody in this case here should be able to give me the depreciation. Somebody should be able to give me the depreciation. Is there somebody who is able to give me the depreciation? Is there anybody who is able to give me the depreciation? So is there somebody who can give me the net right of use? The net, after you do those journals, you're supposed to give me the value of the asset. You're supposed to give me the value of the asset. You're supposed to give me the value of the asset. You're supposed to give me the value of the asset. Remember, we had already obtained this. If you remember very well, please look at this. We know that in this case here, we booked this liability at 31,551. But there were direct costs, which had a net figure of 2,000. So basically, our asset from the beginning is worth 33,551. And therefore, depreciation per annum will be 33,551 divided by 3, which gives us what figures there, somebody? Which gives us what figure there, somebody? 33,551 divided by 3. Oh, they're not talking to me now. I don't know who they want to talk to. I don't know. So in this case here, we have 11,184. So 11,184. So Lydia, like now you know that depreciation is an expense. According to Pearl's expenses debited. So you'll come and they say in this case here, debit, depreciation. And then of course, in this case here, because the asset has reduced, so it goes the other way around. So in this case here, you credit what we call right of what year use with this amount, 11,184. 11,184 like that, 11,184. So then that is what you are required to do in that question. However, there is something very special I would want to take you through. Something very special. This is a very, very special, very, very special, very, very special, very, very special stuff. Now, so you are the accountant of this organization. You are in 2021 at reporting. Remember we report at this closing, at reporting. In this case here, the liability, look at this. So now I'm reporting. If we understand this, then I don't have any business being here with you really tonight. If we understand this, I don't have any business being here with you tonight. If you understand this. So now I'm reporting. I'm reporting at the end of the first year. So on reporting. On reporting here, I have the total liability, being 23 or 129. But you see, you can't report like that in the statement of financial position. A liability has to be broken into two. How much is non-current? How much is what year? Current. How much is non-current? How much is current? So can somebody explain to me how much in this? I would want to give you 1 minute. How much in this case here is the non-current? Out of this 23,129, this one here, how much of it is non-current? How much of this is non-current? Very good. You always look at the future payment. So you look at, non-current means a payment falling due, or rather, which will take more than 1 year from today. So in this case here, more than 1 year, ni space yote hii. Unaona hii? Hii ndio non-current. So nakuja hapo nasema non-current. Non-current lease liability is this figure here, 14,287. And then the difference between the two, thank you. And then there are two approaches here. When it comes in this case here to the current, what will be paid? For us to move from here to here, there is something which has been paid in between. So in this case here for the current, you subtract these two automatically. Don't take this other approach of taking this one. No. You simply subtract this and this because we have moved in the 12 months. We've moved from here to here. So there's a payment which has been done within, or which will be done within 1 year. Within 1 year. So the current I'm being given, it is 88,44,43. this difference, you take this minus this. So the current is 88. The current is 88, 42 or 40, doesn't matter really, 42 like that. And then you'll get all the marks. Like December 2022, they really confused our students by asking them to apportion the total liability into non-current and what-year current. Very few students were able to do that. Very few students were able to do that. So the question is, have you learned something now? Have you learned something? Have you learned something? Normally, Lois, thank you very much. The most important thing here is that you're working with this top year. If they tell you to spread for the other years, now you can do a schedule, which I'll be able to show you like the December 2022. Great. Thank you very much. Then I'll be able to go to the last thing. Before I look at the past papers, I would want to go to this thing that happened in Uchumi, which KRA had a big issue with Uchumi Supermarket. Remember when Uchumi Supermarket was closing down, they had a big tussle with KRA. And one of the biggest mistakes that Uchumi Supermarket did, they were not handling IFRS 16 nicely. Because what they did because of corruption, the Uchumi Supermarket at Aga Khan Walk, the head office, Uchumi in this case here sold the head office to an entity and then told that entity, you know what? I don't want to go away. I don't want to go away. I don't want to go away. I would want to stay here. So basically, in this case here, they sold the building and then they leased back. They sold the building and then they leased back. So in this case here, when you sell a building or a property like that, there will be a capital gain. So there must have been something that they did there. And I believe it is that really the lawyers, maybe who never advised them very well. Because in this case here, how that building was sold, it was sold in a very funny way to an entity related to directors, right? And it was sold at a very low amount. And now they were saying that they made a capital, that's Uchumi now, they made a capital loss. So in this case here, that is when the taxman came and said, if you made a capital loss because you decided to help through corruption the directors of Uchumi, right, then we shall not work with what we call the buying price here. No. We shall value this thing at market rate. So we shall take the selling price to be what here? Fair value. And it brought a lot of issues. They have made losses by selling a whole building, in this case to existing directors, at almost, in this case here, peppercorn amount. And then again, KRA now is asking for about 1 billion Kenya shillings in terms of what here? Tax. All right. Great. Related party. Alessandra, you are really understanding this thing. Related party now brought issues there. So what I would want to show you guys here is what will happen if in this case here, ladies and gentlemen, we have this situation where we have a sale and lease back. And this is very interesting because it's something we'll be able to basically relate with here very fast. So ladies and gentlemen, here we are. It's called a sale and a lease back. Like now they brought this question on lessor accounting the other time, just last year, and many students were not able to do this thing from the perspective of the lessor. I'll be able to do it today. So sale and leaseback. I'm reading here. If an entity, the seller, lessee, transfers an asset to another entity, the buyer, and then leases it back, IFRS 16 requires that both entities assess whether the transfer should be accounted for as a sale. For us to be able to understand what we are talking about, I would want us to look at this question called painting. Test your understanding 9. On 1st January 2021, Painting sells an item of machinery to College for its fair value of 3 million. The asset had a carrying amount of 1.2 million prior to the sale. This sale represents the satisfaction of a performance obligation in accordance with the IFRS 15 revenue from contracts with customers. Painting enters into a contract with the college for the right to use the asset for the next how many years? 5 years. So the lease term is 5 years. The lease life is 5 years. Annual payments are 500,000 are due at the end of each year. The interest rate implicit in the lease is 10%, which is irrelevant because, after all, this examiner has given us the present value of the annual lease payment is 1.9 million. The remaining useful life of the machine is much greater than the lease term. So meaning that if the remaining useful life, like it could be 20 years, etc., if it's bigger, then when it comes to depreciation, I'll take always the lower as the depreciation duration. So basically, the depreciation duration is 5 years, because I'm told here that the remaining life is quite high. So required, explain how the transaction will be accounted for on 1st January at the beginning. Normally, they'll ask you at the beginning here. At the beginning. So at the beginning, ladies and gentlemen, there are very few things I will do really here. Here I'll get all the marks, because I know at the beginning is the simplest thing that you can ever give to somebody who is going to graduate with this CPA. So at the beginning, if it's a lessee, from the lessee's perspective, then I must, ladies and gentlemen, in this case here, account for two things. I must account, in this case here, for the leased liability side, which already they have given me the present value, a free mark there. So I know the leased liability will be going for 1.9 million. But now for right of use, remember right of use for an asset that is sold, asset sold and the leased back, asset sold and the leased back. The right of use, ladies and gentlemen, we have a special formula. The right of use will always be equal to present value all over future value, in this case here, times carrying, not future, but fair value, times carrying value, or a net book value. So anytime you get to see a question talking about an asset like Uchumi, which has been sold and the leased back, right of use can never be the same as the value of leased liability, because here I must always make use of this formula. Right of use equals present value all over fair value. Fair value is what we traded at. We traded the asset at, multiplied by carrying value. So in this question then, is there anybody who is able to see the present value? Is there anybody who is able to see the present value? In this question, the present value, you simply look around, the present value of the annual lease payment is 1.9. So I'll use millions. So this is 1.9. And then I'll be able to look for the fair value. The fair value they're telling me here on 1st January 20, whatever, painting sells an item of machinery to college for its fair value of 3 million. Times, in this case here, carrying value, the asset had a carrying amount of 1.2 million prior to the sale. So, ladies and gentlemen, if you're keen enough, then we should be able to get something there. They're telling me that this is carrying value is 1.2. So are you able to get, in this case here, this right of use? Good question there. Katika right of use here, hapa kwa present value, can we say lease liability? Yes, because lease liability and present value are always the same. They're always the same. But I mean, if I were you, you can even see that this is fancy. It's fancy, saying PV over FV times CV. That's why I captured this. Times CV, PV over FV times what here, somebody? CV times CV, like that. Great. Aki awaongei sana, but we shall overcome. We shall overcome. We shall overcome. So wanasema ni 0. What here, somebody? 0.76. So this is 0.76. Then, ladies and gentlemen, I would want you guys to do me a favor. I would want to give you exactly 3 minutes. 3 minutes, you do the double entries for this right of use. You do the double entry, not right of use, but for this sale leaseback transaction, for the whole sale and leaseback transaction. Could you kindly do the debit and the credit, the journal entries for everything now? Okay. Great. Great. I can see you guys are way ahead. I can see you guys are way, way ahead. I can see you guys are way, way ahead. I can see you guys are really trying. I can see you guys are really trying. But one thing I'm disappointed about all of you. How can you tell me that the lease liability is 0.76? Lease liability is present value always. Lease liability does not require any adjustments at all. You can make adjustments the right of use, but lease liability, we don't adjust at all. So then if I'm the one, because I would want, first of all, to have like debits here. So I'll write here debit. I can write as many debits as possible. And then I can write like 3 credits. So that whenever I know that there's something to be credited, I follow. You know, you're supposed to have like debits first of all, then but of course in an exam, you can mix them up. I always mix them up myself. I don't care. So in this case, the first thing I will debit here is the right of use because I have an asset now. So we have here debit, right of use, which you guys gave me a figure of 0.76. And then umeniambia credit, in this case here, lease liability. No, the last one doesn't have to be this one. Or okay, credit, lease liability, no problem. Credit, lease liability. What is the lease liability amount? The present value that you guys gave me was 1.9. 1.9. Now, ladies and gentlemen, I may forget about everything, but I will never forget Mbesha. I sold an asset. When I sold this asset, I received cash, fair value of the building. So in this case, I have received Mbesha. So in this case here, Mbesha, I will debit. So in this case here, debit cash, stroke bank. Is there somebody who is able to see the amount of cash, stroke bank, that I received by selling this? It's a sale and leaseback. It's a sale and leaseback. Is there anybody who is able to see this amount? Is there anybody who is able to see this amount? Is it 3 or 1900? These guys are not talking to me really. They're not talking to me really. They're not talking to me really. 3,000, isn't it? My figures are in millions, eh? So 3, my figures, but you can put yours as you wish. Now, as I receive this money, it's in the bank, I know that I've also lost some assets. I've lost some property, plant, and equipment. So this property, plant, and equipment that I've lost, I have to write it off. And I normally write it off from my books at net book value. At net book value, which is the same as carrying amount. So in this case here, when I'm losing an asset, I credit it. So I'll come and say, in this case, this is a machine. So it's a property, plant, and equipment. So in this case, ladies and gentlemen, remove carrying amount. Remove carrying amount. Remove carrying amount. So the carrying amount, ladies and gentlemen, in this case is how much? Yeah, you can call it machinery. So in this case, they're telling me 1.2 million. 1.2 million. They're telling me it is 1.2 million. Yes, 1.2 million. 1.2 million. You guys, you are really aggressive. You're really aggressive, very aggressive. So have I taken care of the most important thing? I've received my right of use, but I know here I have a lease liability. I have received, in this case here, cash and removed this machine from, in this case here, from where? From my books, like that. So balance your debits and the credits. Balance them up. Balance them up. Tell me, in this case here, which side is, or rather, balance this up. So you take this plus this, credit you subtract. You subtract, you subtract. So abracadabra, unasema 0.76 plus 3 minus 1.2 minus 1.9 minus 1.9. What do we have there, ladies and gentlemen? If positive, credit is smaller. If positive, so I'm so sure if it's a positive figure, the balancing figure is on the, we'll go to the credit side. 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 Okay, so in this case here, we shall credit. So it's so in this case here, we'll come and credit profit stroke loss. And it's again because it's a credit of 0. What here, somebody? 66, I'm being told. 0.66 like that. 0.66 like that. And then you get all the marks. You get all the marks. And then you get all the marks as this solution is showing you guys. You get all the marks. I love this. So before I look at this question asked there, I would want us to look at our past papers. First of all, up to here, and remember KASNEB is very, very fair. By the way, ukifanya exam ya KASNEB upate unakamatwa, usiblame anybody sana pia. Saa zingine nakuwa ni huja prepare at all, because KASNEB, utaona hata usipopata hii figure correct. These guys mark entries. The mark entries will end up getting like 2 out of whatever. The mark entries. So KASNEB is a fair examination body. It all matters, or rather what really matters here is how confident you are. How confident you are. So in this case here, if for example, in this case, ladies and gentlemen, still I would have debited. If for example, in this case here, if you got a negative here, ungekuja useme debit P&L. Lakini ungesema sawa, you're debiting P&L, ungesema ni loss. Thank you for that question. You would have said it's a loss. You would have said it is a loss. If for example, I got a negative answer here, I would have debit. I would not have credited. I would have said debit. I would have brought this figure here, debit P&L, but into brackets now it's a loss, and then I write 0.66. Thank you for that question. Thank you for that question. Great. So we are not taking any break. We are not taking any break. I'm just getting my question paper, and then we continue. Just 1 minute. Thank you. So then, ladies and gentlemen, I would want us straight away to look at this question that was tested in December 2021. December 2021. Let's go to December 2021, question number 3. December 2021, question number 3. Once you get it, please let me know. Put a thumbs up. Once we get it, let me know. Put a thumbs up. December 2021, question number 3. December 2021, question number 3. December 2021, question number 3. Do we have it? Beth is saying yes. Beth is saying yes. December 2021, question number 3. So it's only Beth who has gotten it. Harry Limited. Harry Limited. Is it Harry or Voxy? No, it's Harry. It's Harry. But I would want to start with this one that we have just done here. The one that has got sale leaseback. The one that has got sale leaseback. It's Harry Limited, which has got sale leaseback. It's Harry Limited, which has got sale leaseback. December. So tuko nayo. So Harry Limited sold a building at its fair value of 112 million to a finance company on 31st October 2020, when its carrying amount was 78.4 million. The building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years. So when I compare 25 vis-a-vis the 5, I know depreciation, I'll be using the lower. So the remaining economic useful life of the building was deemed to be 25 years. So it could be concluded that control of the building had been transferred to the finance company. Lease rentals are 98,56,000 payable annually in arrears. So we have here the interest rate implicit in the lease is 7%, which is useless thing. Why is it useless? Because they have given me the present value of the annual lease payables was 40.32. Harry Limited recorded the cash proceeds that it recognized the building, which is very good, and recorded a profit on disposal of 33.6 in the statement of profit or loss. No other accounting entries had been posted. With reference to IFRS 16 leases and with suitable calculations, explain the accounting treatment of the above transactions in the financial statements of Harry Limited for the year ended 31st October 2021. Ladies and gentlemen, here you will get so many people trying, because they've been told here to explain. They're trying to write so many. No. Here, basically, they want things like extracts. They want things like, for example, like those journals, etc. So if you got this kind of a question, what will I do? So long as I've underlined sale leaseback, I will calculate row. I will calculate row. So Deborah, we are doing December 2021, question number 3. So I will calculate row. That's the first thing I will do. So I will come here and calculate row. And how do we get row? So to get row, we are taking, in this case here, the present value all over the fair value times, in this case here, the carrying value times the carrying value times the carrying value times the carrying value times the carrying value. So is there somebody who is able to see the present value? Is there anybody who is able to see the present value? Now they are not talking to me. The present value. Anybody who is able to see the present value? Present value. Present value, it has been given to me. It's 4320. It is 4320. All over fair value. How about fair value? How about fair value? How about fair value? Fair value. Fair value has been given up there. Remember, my figures are in thousands. Remember, my figures are in thousands. Remember, my figures are in thousands. So 112,000. I like that. 112,000. It's given the fair value is 112,000. Multiplied in this case here by the carrying value. So the carrying value, is there somebody who is able to see the carrying value? 78,400. My figures are in thousands. So can you kindly go ahead and give me the row? Can you kindly go ahead and give me the row there? Give me the row. So they're giving me a figure of 28, 28, 28, 22, 28, 224. 28,224. Thank you very much. Now, from there, ladies and gentlemen, I've got everything. What I need to do is to come and mention, because it's this thing of say leaseback. I can come and write many debits there, and then I write many credits there, like that, and then I start to mambo twangu sasa. Because what they wanted me to do there, one of the things as an accountant, to be able to do the explanation, is to come and give them the journals. So is there somebody who can give me the items that I need to come and debit very fast? Can someone tell me the things that I'll be debiting here very fast? Somebody tell me the things that I'll be debiting. Can even cram this? Things that I'll be debiting. Bank. So in this case here, debit bank because you are receiving money. So we are debiting bank by how much here? 112,000. 112,000. We are debiting, as you guys are telling me, right of use. Right of use, you guys have given me 28, 224. So debit, wachana ikae hivyo blank. Enda kwa credits. So kwa credits, what do we have here? Kwa credits. Kwa credits, what do we have here? Kwa credits. Kwa credits. What are we supposed to come and credit here? The asset itself, isn't it? So the building, you can call it building or PPE. Building, which you sold, or PPE, like that, because you have this in there, account there. So the building, of course, in this case, you credit this with carrying amount. So are you able to see the carrying amount? Lease liability, yes. So lease liability, yes. So lease liability, yes. Lease liability, yes. So lease liability 4320. Because lease liability is always the present value. Lease liability is always the present value. So the only thing you guys never gave me is the PPE, which I will credit there in terms of what here, somebody, in terms of the carrying amount. So carrying amount is how much here, somebody? Carrying amount is 78,400. Carrying amount here is 78,400. And then now kuja toanisha. Unajua debit na add, hii unatoanisha. Ukipata positive, it's a profit, it's a gain. Positive is a profit, is a gain. And if it's a gain, you shall credit the profit and loss. Somebody tells me it's a gain. It's a gain. Somebody is giving me a gain. Somebody is giving me there 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 a gain. So do we have a gain? A gain of how much? They're not talking to me. A gain of 21,504. So in this case here, if it's a gain, we are crediting the profit and loss, which is a gain of 21,504. 21,504, like that. Now, ladies and gentlemen, after that, now there are things that I would want you guys to do for me. If it's an explanation, I have to do that lease liability schedule. That's very important. The next thing I'll do is the lease liability schedule. You simply go there and scare the examiner right there in capital letters, right there in capital letters, the lease liability schedule. The lease liability schedule. The lease liability schedule. Lease liability schedule. So the lease liability schedule. The lease liability schedule, what do I have? Have they given me the years? Somebody mentioned there that I should write years, which is very good. Have they given me my years there? Yes, I think they have given me the years. So in this case here, we have 31st October 2020. 31st October 2020. 31st October 2020. So in this case here, actually, I will simply come and mention there 2020. I have 2021. So October 2020, October 2021. They mentioned a good number of years. They mentioned a good number of years, a good number of years, a good number of years, a good number of years. So they wanted me to give them what year? With reference to International Financial Reporting Standards, IFRS 16, and with the suitable calculations, explain the accounting treatment of the above transactions in the financial statements of Heri Limited for the year now ended 31st October 2021. So I'll only do 2 years because I would want to just give them what will happen in 2021. But in 2021, because of the future, then I have to go to 2022 because they want me to explain this year. So I have to go to 2022 like that. Abracadabra, I have opening. I have finance cost. Finance cost. I have finance cost there. I have, in this case, ladies and gentlemen, all the payment. I have the payment. I have the payment. I have the payment. Then after payment, of course, we have, in this case here, the closing. We have the closing, payment and the closing. So finance cost is what, Lois, that will come later. That will come later because we don't bring depreciation what year? here. That will come later. That will come later. Okay. Now, ladies and gentlemen, what we shall do here very fast, do we have in this case here the opening? Do we have the opening lease liability? You'll understand, Ken. You see, ukiangalia wamekuambia wanataka hapa for 2021. So they would want me to give a report here. So to give a position here, then I have to know the years which are coming there after that. So in this case here, the opening is 40 or 320. So have they given me, the finance cost now will be used here. They gave me 7%. So could you kindly give me the 7% of this now? 7% of this gives me how much? 7% of this gives me how much? 28.22. 28.22. Have they told us how much we shall be paying? Have they told us how much we shall be paying? The lease rental? Is there a place they have mentioned how much we shall be paying as lease rental? 98.56. Actually, this one is very easy because I can even copy 98.56. You can copy like that. 98.56, you can copy like that. 98.56, you can copy like that. Because it doesn't fluctuate at all. So then could you kindly do me a favor by giving me the closing? Give me the closing for this year. Give me the closing for the first year. So you take 43.20 plus this minus this. So they're giving me a good figure. They're giving me a nice figure there, 33.286. 33.286, thank you very much. So then come and open this here, 33.286. Please charge 7% to this. Charge 7% to this. 23.30. They're giving me a figure of 23.30. Please take this plus this because interest increases the liability. And then the liability goes down with the payment. When we pay, the liability goes down. For you to give me the closing here, the closing is 25,760. 25,760. Thank you so much. So come and put this here, 25,760, and then please charge 7% there. Charge 7%. I can see Leshamta giving me 1803. 1803. So please take this, add here, and then you subtract here. Add here, and then you subtract there. 1803. I'm being given a figure of 1803. They're giving me different figures now. They're giving me different figures. 17,707. 17,707. So then, ladies and gentlemen, having gotten this, I would want you to give me an extract. In this case here, give me an extract. SFP, extract, statement of financial position. Extract, statement of financial position. Extract, statement of financial position. Of course, I will have in this case here in the assets. I'll be having here right of use, but don't forget depreciation. Don't forget depreciation. Right of use versus depreciation and the assets. And then we shall be having what we call liability. We shall be having what we call liability here. Liability. So liability, basically here we shall have here liability. You have to be very careful. In terms of liability, we have the current lease liability and non-current lease liability. So we have here liability. We have here current lease liability, and then we have in this case here the non-current lease liability. Okay, so let's be very, very careful with the dates now. Let's be very, very careful with the dates. Let's be very, very careful with the dates here. Let's be very, very careful with the dates. Now, when do they want us to provide this report? When do they want us to provide this report? Let's be very careful with the dates here. So with reference to International Financial Reporting Standards, IFRS 16, leases, and with suitable calculations, explain the accounting treatment of the above transactions in the financial statements of Heri Limited for the year ended 31st October 2021. Let's be very, very careful here. Now, this opening here is for which date? The opening here, can someone talk to me? The opening, when we begin this, is for which date? Is for which date? The opening here is for which date? Abracadabra. The opening is for which date? 2019, are you sure? The opening, we are told there, is for 31st October 2020. 31st October 2020. This one here is 31st October 2020. Yeah. So the closing in this case here is which year? Can somebody give me this date here? So it's of course 1 year exactly after this. So 1 year exactly after this, it will be what date? Somebody here, it will be first. The day in this case here immediately after this. October 20. Wewe ngoja tusichanganya hapa. Ama October 2021, yes. October 2021, yes. October. So this one here is October 2021. Thank you so much. Thank you so much. So then they want us to explain, in this case here, the year ending 31st October 2021. 31st October 2021. 31st October 2021. So remember, this is the beginning. This is the beginning of 2020, and this is the end of that financial year, which is October 2021. And then, of course, we start here. We go to the following year. So basically, they want you as an accountant to account for this figure. Actually, this gentleman who was asking why we need this particular year, we don't even need it. We don't need it, but there is no problem having done it. So then can somebody, especially in terms of, ladies and gentlemen, this liability, is there anybody who is able to give me out of this? Is there anybody who is able to give me the non-current lease liability? Is there anybody out of this? Is there anybody who is able to give me the non-current lease liability? Let's start from there. The non-current lease liability. The non-current lease liability. It will be the following year. So it is 25, 25, 25. In this case here, 75, 60. So in this case here, in your good notes there, the non-current lease liability will be this one here. Always the following year, the future. The liability which will be settled in the future, more than 1 year. It is this 25, 760. And then remember that the difference is what gives me what will be paid in the current year. What will be paid in the current year. So this minus this gives me what figure? Somebody there? 75, 26. 75, 26. So this is what will come here. 75, 26. 75, 26. And then we come to the asset side. So asset side, we have right of use. Do we have the right of use, ladies and gentlemen? Do we have the right of use? Do we have the right of use there? Do we have the right of use? Do we have the right of use? Wait, they're not talking to me. They're not talking to me. Do we have the right of use? 28 to 24, isn't it? 28 to 24. Here inanga scrap value. So straight away, come and give me the accumulated depreciation. Fortunately, in this case here, this is just 1 year. We began here. It's only 1 year that has lapsed. So then depreciation will be 28 to 24. Divided by how many years do we have in this case? If we say lease life is lower. How many years are we talking about somebody here? How many years are we talking about somebody? How many years are we talking about somebody here? 5 years. 5 years. So can somebody give me this figure here, ladies and gentlemen? Can somebody give me this figure here, ladies and gentlemen? Can somebody give me this figure, ladies and gentlemen, here? Can somebody give me this figure, ladies and gentlemen, here? Wait, niko peke yangu, lakini I will overcome. 56, 45. So you subtract and then you give me an answer. It's an extract. It's not a complete. It's an extract, it's not a complete thing. It's an extract, it's not a complete thing. And then, of course, whenever it comes to leases, in some cases, you will get confused with these dates. If you look at even marking schemes of KASNEB, by the way, at times they don't even go here. They can just give you all the marks by doing this. This is a very, very important schedule. Very, very important schedule. Ladies and gentlemen, please listen here. If you're trying to follow up to there, that will be very important for us in this case to come and do an extract, profit and loss. So come and give us an extract, profit and loss. Give us an extract, profit and loss. So an extract, profit and loss. In this case here, we have, ladies and gentlemen, in this case here, lease income. Is there anybody who is able to remember the lease income that we got somewhere? Which in this case, we were able to credit the P&L. The lease income. Now they're not talking to me. The lease income. The lease income. Is there somebody who can remember the lease income? 21,504, isn't it? 21,504. Which other expenses will come now? Of course, it's about expenses. Remember, like now we have depreciation somewhere here. This is an P&L item. So come and just mention it here, depreciation. Depreciation of how much here, somebody? Depreciation of how much here, somebody? Depreciation of 56.45. If you want, you can just put like that. Do we have any other expenditure? Do we have any other expenditure? Finance cost, yes. The interest, yes. So we have the finance cost. The finance cost for year number 1. Is there somebody who can give us? Thank you very much, Susan. Thank you very much, Lois. Yes. Is there somebody who can give us this finance cost, which is 28 what there? 28 something, isn't it? 28 something for year number 1. 28, 22 like that. You put in brackets, don't subtract. Those are just extracts. By doing that, then you'll have explained what is happening. But now remember, as I do this, I'm supposed to be cognizant of the fact that time is a big, big factor in AFR. I'm not trying to look at the nitty-gritties. I'm not trying even to be perfect in this. What I would want to teach you here today, ladies and gentlemen, is how to get the raw, how to get, in this case, those journal entries, get that profit or gain or loss there. Very, very important. And then know how to do this liability, the lease liability schedule. And then you can now even have a place where you keep on telling them current liability. Now, if you can reach there, you are a very good student. There are very few students who will be able to reach to that particular level in this country. Very few students, trust you me. I will not really want to waste a lot of your time, ladies and gentlemen, but in terms of where we have reached, are you gaining value? I don't want to be the one who is really confusing you and the yet. No, this is something ambayo nimefunza for long. So long as you are able to get, in this case here, some, you know what happens? Like now the students who have done AFR before here, if a student did AFR and failed, I'm so sure if you did this paper, perhaps you never wrote anything in leases. Please be very honest. Is there anybody who did this particular paper here? This one where we have done this question here. Anybody who may have done this paper? If you're very honest, please be very honest. I tell you something here. Please be very honest. Si kuchocha na kuchocha kwa nini? Yeah. So utakuta like I wanasema yes. I wanasema yes. Some of them come on. Wanasema about this paper here. Chances are you never did anything. Because AFR, we are very fair in marking advanced financial reporting, very fair. So the moment you know how to get through, you know how to post those particular journals like that, etc., you'll end up getting so many marks without, and then don't forget the theories. The theories. Like now you can see here, they came and asked us some time back here. Like you can see this question here. This question here of April 2022. April 2022 question number 5. April 2022 question number 5. B. So is there somebody who has been able to get that question? April 2022 question number 5, boy. April 2022, sorry. How can I go 2025? April 2022 question 5. or they're not talking to me. Yes, so they asked us something very simple there. In the context of International Financial Reporting Standards 16, leases, outline the criteria for identifying a lease contract. For identifying a lease contract for the purpose of accounting in the financial statements of leases. Ladies and gentlemen, it's very important that under IFRS, if I'm the one answering this question, I will be able to answer so many things, talk about so many things. I'll read the question again. In the context of IFRS 16 leases, outline the criteria for identifying a lease contract for the purpose of accounting in the financial statements of leases. So how do we identify? And I've read for you from this ACC manual. How do we get to identify, in this case here, a lease? Remember, first of all, I'll say, according to IFRS what year 16, if a lease exists, then the lessee must recognize what we call right of use and a lease liability in the financial statements. That's very important. I'll start like that by scaring the examiner. To be able to identify whether whatever scenario is given has a lease contract well within it, number one, the lessee must have exclusive right of usage of this asset. And for us to talk of exclusivity, then we are looking at control of the leased asset. We should never have situations where the landlord will be able to come and, for example, tell this guy that we will substitute for you. All right. If he says that, then that is not what year. That automatically is not what year, is not a lease. Right. And the moment, of course, you come and mention like it can only be called a lease or a leased asset if all the economic benefits are able to come down to this lessee. All right. And then, of course, at the end of the day, he must be having an obligation to pay. There must be an obligation of payment of lease rentals. If your father gives you a house and he tells you, hey, this is a lease I've given you, you stay there, and then at the end of every month you're not paying, or at the end of every quarter you're not paying anything, then that will not be a lease contract. Because for it to be a lease contract, it's an asset, and then you have a liability. And this liability, you are doing what you're extinguishing the liability as you get along, as you get along. So the moment you write like that, ladies and gentlemen, then you will be able to do what here to get like all the marks there. I'm so sure for those of you who have done this paper before, that kind of an explanation, international design. But now, today, moving forward, I'm so sure if you're given that kind of a question, like how do you identify that a lease contract exists? You know, we can only talk of a lease contract if there is a lessor and a lessee. And that kind of a relationship can only exist if the lessee is able to enjoy what year benefits. If he has got control over leased assets, if any economic benefits that are coming out of, like now at RCM physical classes, if students pay fees, ladies and gentlemen, they pay fees to me. So I'm able to enjoy like that. And then at the end of every quarter, we are able to pay our what year, our rental obligations there. So then automatically that becomes, even you meet a meal, you will be like a genius. If you allow Mwalimu here, he will be able to do what, ladies and gentlemen, he'll be able to go straight away to lessor, the lessor accounting. So as a lessor, how do you account? Yeah, thank you very much. Immaculate. Yes, the lease term in this case here period should be what? Here should be long term, more than a year preferably. Remember, if in the lease, we have what we call short-term contracts of minimum value. Also, that disqualifies whatever scenario you have to be called what year? To be called a lease. Minimum value, short-term contracts outside. Thank you very much, Opiwa. Very good. Once you have those kind of points, then you are a genius like that. So can I do this question? Can I do this question of December? Can I do this question of December 2022? December 2022. Can I do it very fast? December 2022. These guys are not getting even the question itself. These guys are not even getting the question itself. These guys are not getting the question itself. These guys are not getting the question itself. Please, once you get it, could you kindly put your thumbs up like this? Put up your thumbs like this. So we are told here, December 2022, question number 1, boy. Voxy Limited leased a factory to Tiana Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rental of $4,000, payable annually in arrears. The lease contract provides that the leasee shall be responsible for the insurance and maintenance of the factory during the lease term. Of course, that is another way of telling you that this is really the lessee's asset, because he is the one who will suffer most should the building, for example, in this case here, get burnt. It's consumed by fire. So the lease contract provides the lessee shall be responsible for the insurance and the maintenance of the factory during the lease term. The implicit rate of interest is 15%. Demonstrate with suitable calculations the accounting treatment for the above lease transactions in the financial statements of Voxy Limited, lessor, for the years ended 30th June 2023, 24, 25, 26, and then they are giving us 10 marks. This is not a serious examiner. You don't give 10 marks to this kind of a question, really. This is a very easy question. This is a very, very easy question. Now, ladies and gentlemen, the lessor this time round, the lessor Ndiakona Bahati, this guy will be receiving what we call lease income, lease rentals. To him, lease rentals are his income. So then what I would want to do is to project his cash flows, discount them. If you even understand nothing, the moment you're told that this guy will be receiving rent, no problem. Just do a schedule where in this case you do present evaluation of the lease rental income. So in this case, remember this is the lessor. Remember that this is the lessor. I'll be able to pick many marks here without even knowing what I'm doing. So this is the lessor. To understand him very well, I would want in this case here to do, I would want in this case here to do, I would want in this case here to do, in this case here, a projection of lease rental income. So we have our years 2023, 2024, 2025. They've told us 2026. So have they told us how much we shall be earning every year? Have they told us how much we shall be earning every year? 4,000, isn't it? Lease rentals. Lease rentals. We have 4. I would rather we put this in thousands, right? We put this in thousands so we don't get into writing so many numbers. So we have here 4,000, 4,000, 4,000, 4,000. They're coming in different periods. As a finance guy, I know that the next thing will be for us to do what here to discount. So you need to come and discount this. So come and give us the present values. You can decide to treat this as an annuity because you know it's regular. But for some reason, advanced financial reporting prefers PV for some reason. Advanced financial management, they prefer, of course, whichever you use, you'll end up getting the same answer. But financial reporting, they prefer us treating this as if they are independent, as if they're what year, as if they are irregular. So then I'll use PV. Have they given me the cost of capital, somebody? Please talk to me. Have they given me the cost 15%? 15%. So abracadabra, I know the formula. It is 1 plus R raised to negative n. R is 0.15. So then this will be 1.15 raised to minus 1, 1.15 raised to minus 2, 1.15 raised to minus 3, 1.15 raised to minus 4. So please come and give me the figures here. Please come and give me the figures here. Come and give me the figures. I hope you guys are seeing where I'm getting 1.15 from. I hope you guys are able to see where I'm getting this 1.15 from. Caroline gives me 0.8696. 0.8696. That's Caroline. And then the second one, Ken Kim. Very good of you. Thank you very much. Thank you very much. Now we are looking at the second one. The second one. So then this gives me, ladies and gentlemen, this gives me something very nice. So 0.8696. The next one in this case here gives me 7561, 7561. And then we go to the next one, 7561. The next one is 6575. 0.6575. And then the last one, here 45718. 5718. So come and give me the present value. Whole number alone. Whole number. I want whole number because I want us to move very fast. Whole number alone. 3478. And then we have in this case here this and this, giving me what figure? Year number 2, 3024. Thank you very much. 3024. And then you go to the next one, 4,000 times this will give us what figure? 2630. And then we have the last one, 4,000 times this will give us what figure? 2287. So could you kindly add for us? This is the total present value. Total present value. So they're giving me a figure of 11,420. 11,420. This is 11,420. Now remember, if it was the lessee, would have called it a lease liability. For the lessor, we call this one net investment. So this is what we call the net investment. This is what this guy is investing. If it's Stan Bank, yeye amejua ameweka investment yake pale namna hiyo. Net investment. We call it the net investment made by the lessor. Now, ladies and gentlemen, after you do that, then now you need to give us the net investment schedule. The net investment. Hata kama ujui, unaenda straight out unaandika table, unasema net investment schedule. I hope I will remember this figure. Net investment schedule. Net investment schedule. So come and give us the net investment schedule. Give us the net investment schedule. The net investment schedule. So the net investment schedule, what do we have? For our years, we have 20 the first year. This is how I do it. The first year we're given there is 2023. 2024. We have 2025. Then we have 20 what year? Somebody? 2026. 2026. So give us the opening. Give us, in this case, you can't call it finance cost, you call it finance income. Finance income. You give us the finance income. Then in this case, of course, finance income, ladies and gentlemen, we can't call it payments. We can only talk of cash received. Cash received. So you receive cash, it reduces your investment in that building. And then lastly, we have what we call the closing balance. So we have the closing balance, closing balance. So I would want us to start with the net investment that we began with here. 11,420. So please, given your 15%, the cost of capital, given the cost of capital, could you kindly give me the finance income for this year? Please give me the finance income for this year. How I wish everybody would really participate, because I'm here to help you. 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 So 11,420. And then the finance income, ladies and gentlemen, we have here 17 what year? 13. And then the cash received in year 1. Is there anybody who is able to remind us how much we are receiving in terms of lease rental? In terms of lease rental, how much? 4,000. Thank you very much. Don't take that because you're receiving, you take it. No, it is reducing the investment. It's like you're being paid now, right? So then could you kindly come and give me the closing balance here? Give me the closing balance. So you take this plus this minus this. Give me a figure here. Give me a figure. So we have Immaculate giving me 91.33. We have Immaculate giving me 91.33. So come and take 91.33 here, 91.33 there. Is there somebody who can give me this finance income at 15%? Finance income at 15%. Finance income at 15%. So finance income at 15%, I'm being given a figure of 1370. So we have here 1370, and then the cash received is always constant. Actually, I can even finish this cash received column. I can finish it up. I can finish it up like that. I can finish it up like that. I can finish it up like that. So please come and give me this figure here for 2024, end of 2024, end of 2024, end of 2024. Oh yeah, niko na 6503, 6503, 6503, and then we have 6503. All right, times 15%. What are we getting here? 975. Please add this 975 to this figure, subtract this, give me a balance here. Give me a balance there. Give me a balance there. Give me a balance there. 3478, 3478, 3478. Come and take this here. 3478. Please give me 15%. Give me 15% of this. 522. 522. So you add this, and then you subtract 4,000 because it's an investment income, and this thing is coming to an end at 4 years. We expect to get a 0 here. Your investment has been realized. So for the lessor's perspective, when I go now to the extracts, my life is very easy. My life is very easy for the lessor's. From the lessor's perspective, my life becomes very, very easy. Because in this case, I'll come and give the examiner the P and the L extract in free of charge marks, P and the L extract for the lessor. For the lessor. P and the L extract for the lessor. For the lessor. So we have 2023, we have 2024, we have 2025, we have 2026 like that. All right. So we only recognize the finance income, only finance income. We only recognize the finance income. We only recognize the finance income only. So we have here 1713, we have 1370, we have 975, we have 522, 522. So remember here, you can't bring in depreciation because the asset is not yours. The asset is not yours. This asset, you've transferred it to the lessees. So you can't bring in the issue of what here, depreciation. That's it. So can I go to the balance sheet extract? Can I go to the statement of financial position extract? Can I go to the statement of financial position extract? So statement of financial position extract. Statement. Okay. So we have here, in this case here, statement of financial position extracts from the lessor, a lessor's perspective. Lessor perspective. So in this case here, we shall have under assets. Yeah, under assets. Under assets, we will have in this case here, so we have our years, of course, 2023, we have 2024, 2025, 2026, like that. So we have in this case here, under assets, under the assets, we shall have net investment. Net investment. We shall have net investment. We shall have net investment. We shall have net investment, non-current. 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 The closing balances. You don't take them like that. You will not get marks there. So remember, like for 2023, what is the non-current? Balance here for 2023 for the first year? Who can give me the first non-current asset? Abracadabra. Now they are not talking to me. Yeah, non-current is futuristic, isn't it? The next. So hapa unaandika 6503. Unaenda hivyo. Hii inakuwa 3478. 0. Of course, this one here will be 0. 00. And then now you come and they give us net investment, current. Net investment, current. So then what do you think shall we do for us to be able to get the current amounts, like the first one? Someone talk to me tonight. I can see what Stella has. I can see what Stella has there. Thank you so much. We subtract. So like the first one will be this difference here. 9133 minus this. Can somebody give me this? 2630. The second one, ladies and gentlemen, you simply come and subtract those two. You subtract those two, which gives us 30 what here? 3025. And then you come and subtract these ones here. So this minus this gives us what figure? 3478. And then here we have what here? 0. And then you lift up your hands like that. Great. So the most important thing is that you will not be able to get a 0. We don't want to be seeing zeros. You should be able to get more than half of the marks. Now, ladies and gentlemen, I have a suggestion.